Hey everybody, this is Brian, and we're here today to talk about technical analysis, what you think it is, what you've probably been taught that it is, and what it actually is and how it really works in the marketplace. Again, this is a training class that I did with Complete Currency Trader, and we're just hoping to continue giving you this incredible free content so that you can learn more about trading and learn the things that you need to finally be successful in trading. And of course, as always, if you like what you hear, please click the link below this video. It'll take you over to our main site at Complete Currency Trader, and you can register for our free training and really get some great materials, great tools, and great additional training from James Edward, who's my mentor, and that'll help you continue to learn about Forex and help you become successful with a great plan, easy to use and easy to duplicate trading strategy that really will get you on the path to success. So before we get into it, as always, the disclaimer, we have to let you know that Forex trading does involve risk. It may not be suitable for everyone. Of course, before you begin trading, you really need to consider your investment objectives and your level of experience in trading and your risk appetite. I mean, ultimately, at the end of the day, you're the one that's responsible for your own trading decisions. Just need a disclaimer, apparently, to protect yourself from that. So, whatever. If you'd like to read that full disclaimer, you can. You can go down to CompleteCurrencyTrader.com/disclaimer. There's also a disclaimer page on this website at Forex Made Easy. So, either way, you can read about all the potential pitfalls that are involved with trading. All right. Well, let's jump into this. Technical analysis. The definition of technical analysis, it's a technique employed for forecasting future profitable market conditions based on the study of historic market data. So again, a technique employed for forecasting future profitable market conditions based on the study of historical data. That's what technical analysis actually is. In its most popular incarnation, though, technical analysis looks for repeating patterns in price, and those repeating patterns are relied upon to result in predictable reactions to the market in the future. The most utilized method of market analysis is, quote, technical analysis. And again, I'm doing some air quotes over here. You can't see me, but I'm doing air quotes. It is the most utilized market of analysis. But there's some things that we'll really going to dig into that I think will help you understand what it really is and why you really should understand it, and look at the definition of what it is so that you can be looking at the right things that will truly impact your trading versus some theory and conjecture at some level. In a recent study that James did, he found that 97% of the people that he questioned as part of his study classified themselves as, quote, technical traders. 98.3% of those questioned believed that technical analysis involved, to some degree, the forecasting or predicting a future price direction. And that's interesting because that's what I hear a lot as well when I talk to other traders. They think that technical analysis is all about predicting which direction price is going to go, but it absolutely is not. Again, we just have to really look at the definition of that. The technical analysis is attempting to forecast future profitable market conditions. There's no mention, when you look at the definition of technical analysis, in predicting price direction. That subtle difference right there, just simply stepping back, looking at the true definition of technical analysis and seeing that subtle difference, which is very easily overlooked and it's often hugely misinterpreted, has great ramifications on how the practitioner of technical analysis is going to pursue the discipline of applying that. It's huge, and I hope you can see that. I think just in the first couple of slides here, we've probably hit on one of those aha moments for you that'll make you realize that maybe what you've been looking at really isn't what it is, and maybe leading to some of the poor decisions that you're making when you're trading. The objective that we're going to do today is to educate you about the myths and the inaccurate teachings about technical analysis and inform you of a way that you can genuinely have statistically relevant aspects for your trading. One thing that James has said before, for the struggling amateur attempting to locate sound techniques and knowledge, the overwhelming misunderstanding of what technical analysis really is proving to be a huge obstacle to success. And that's very, very true. I mean, again, coming back to it, so often people that are applying, quote, technical analysis think they're applying that in order to predict market direction, and it has nothing to do with that. It has everything to do with simply forecasting future profitable market, good trading market events. Good market conditions is what it really is. So the origins of technical analysis, it's thought to be originating, some time ago, 17th century in the Dutch markets. But then we have what most people really look at today, which is the candlesticks, and that was developed in Japan in the early 18th century. And we really gathered pace and gathered popularity from the early 20th century on, as again, more use of candlesticks methods developed around candlesticks, and then of course other methods were built and developed. And we've got the Dow theory, Elliott wave, Bollinger Bands, Gann analysis, so on and so forth. The markets, the theory behind technical analysis is that the markets, because they're comprised of humans, that will always act as a collective, and the behaviors, the actions, the reactions can be predicted. That basically crowd behavior is going to manifest itself in the price, and in doing that, we can see patterns of behavior that will allow us to identify future behaviors. So as we see certain things happening in the marketplace, because we're humans and we see that, the crowd's going to move in a certain way and help us identify future things. Well, of course, the reality behind it is that that's not true. There's been no form of technical analysis that's ever conclusively been proven to offer any statistical advantage to being able to forecast or predict future price direction. A coin flip is just as accurate. It's a 50-50 shot going into it. That's all it really is. Price comes to, let's say, a support level. It's either going to bounce off of it or it's going to move through it. It's a 50-50 shot. You don't know what it's going to do. A coin flip is just as accurate. Technical analysis was first conceived, and it was used in speculative markets, and those are very, very different from the currency market. That's something to remember. Currency markets do not act in the same way that a stock market acts or that a futures market acts. Remember, again, just some other notes, and these were covered in some prior trainings, but spot Forex accounts for $1.5 trillion of the $4 trillion Forex market. So spot Forex, what we're trading, you and I are trading as retail traders, is a very small percentage of the overall $4 or $5 trillion a day Forex market. And you hear that bantered around a lot. Oh, Forex is a $5 trillion a day or a $4 trillion a day market. It's the largest market in the world. Well, that's true, but spot Forex only accounts for a very, very small part of that. The main activity in spot Forex is banks trading amongst themselves as market makers. They're the ones that are changing hands with orders going in and out. Speculative trading only registers about 10 to 30% of that spot market in itself. So you've got the spot market, 1.5 trillion, so less than half of the full market, and then less than 30% of that is actually speculative trading. So it's very, 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 very different from the markets that technical analysis was first based on, which is a transaction-style market. Now, common technical analysis relies on the crowd being aware of and paying attention to the same things which influence behavior. Now, possible influencing factors could be earnings reports, yields, dividends, news announcements, crashes, so on and so forth. So, if we've got something that where the majority of speculators might be watching the same thing, yeah, of course, their patterns and behavior could be influenced and have a direct impact. That very well could be. But because Forex is mainly non-speculative, those techniques can't work. They can't work in spot Forex trading. It's not possible. So back to the definition, right? How do we get back to the definition? Well, the definition is to identify repeating patterns in price which have a greater than 50% probability of resulting in future market conditions which can be exploited for profit. So again, pay attention to the words. It has nothing to do with forecasting price. It has everything to do with understanding the market conditions. So genuine, true technical analysis merely attempts to identify patterns in the market that can lead to profitable opportunities, patterns which can repeat and be predicted, opportunities which can be repeated and predicted. So again, let's make it very, very clear. Prices do not move in response to moving averages. They do not move in response to the shape of a candle or a bar or trend lines or any other oscillator out there. It has nothing to do with it. Price is not going to change direction just because it comes to the top of a range or top of a Bollinger Band or has crossed above, just because two moving averages have crossed one another. It's not going to move because of those things. Prices only move in response to limit orders being consumed by market orders. That's all. That's the only reason prices move. Any patterns that we look for need to be centered on that underlying principle of price movement. It all has to do with order flow, nothing else. That's the only reason prices move, is because of order flow, not anything to do with moving averages, candle shapes, support lines, or anything else. Has nothing to do with it. So how do we exploit this then? How do we actually apply real technical analysis to the marketplace? How do we do that? Well, we have to understand the market, how it works, and what technical analysis really is. So the basic requirements to make a profit: prices have to move, the price movement has to exceed the trading costs, and there has to be sufficient liquidity in order for us to be able to trade, right? Now, there's three main markets. We have the Australasia market, we have the European market, and we have the U.S. market. Some repeatable facts, right? Some things that we know to be true over and over again. Europe, the European market, which is led by the London session, is the most active trading session in the world. The U.S. session is next in line. And then we have the Australasian session, which is the least active market. And anyone that's watched the spot Forex market trade, if you've watched it throughout, a multi-market session period, you'll know that, come 7 o'clock Eastern time, the markets are very, very slow. We only have the Australasian markets online. We've got Sydney's online, and Tokyo's not online quite yet, and the markets are very, very slow. There's not a lot of activity. But if you look at it at 3 a.m. in the morning Eastern time as London is open, you'll see that the markets are going crazy. And then, of course, as U.S. comes online, it really adds to that. There's a lot of activity during those times. We know that. We know that that's a quantifiable and repeatable fact. The average range of prices from high to low during that London/European time session is significantly greater than what we would normally see during the Asian market trading. Again, it's something that's quantifiable. It's something that we know to be true and can be supported by facts over time. Quantifiable patterns. Well, we know that with near certainty that we can make a prediction that between 8 a.m. and 5 p.m. GMT, there will be more price movement and higher liquidity. And that's in comparison, to the 10 o'clock to 7 a.m. Australasian session. There's significantly more liquidity. There's more price movement and there's higher liquidity than there are in other times in the marketplace. We know quantifiably that genuine and relevant conditions, not patterns or shapes, exist. That there's more participants in the market, we have overlapping time zone, we have more exchanges of currency, and we have more dealers and market makers in the market during those times. That's very important. It's important to know that because we need to have those conditions present in order for us to trade successfully, right? So here's some more sound logic. Again, quantifiable information that's repeatable, and it's something that we know to be true because we can back it up with facts. Japan, the JPY, is more heavily traded during the Japanese market hours. The euro is more heavily traded during the European session. The euro USD is quiet during the Asian session, becomes alive in the euro afternoon, U.S. morning when the USD comes online. The odd yen is going to see more activity during the Australasian session than it might during the U.S. session. Again, quantifiable conditions backed by sound logic. So the educated trader is going to look at technical analysis, real technical analysis, to find out if there's reduced liquidity in one pair versus another, if there's reduced liquidity during certain market hours. The educated trader is going to look at the spread costs on various pairs, the profit potential on various pairs, the level of volatility between pairs and hours of the day. So, in other words, the educated trader is going to look for genuine patterns produced by real market activity. It's based on the real way the market works. It's based on market microstructure. It's based on order flows, supply and demand. These are things that the educated trader is going to look at, not painted candles on a chart that can vary from broker to broker, vary from time frame to time frame, and not offer any real true advantage to your trading. I mean, the humans we're predispositioned just from our ancient survival mechanism to look for patterns. We're always looking for patterns. We look for patterns because in our past, that was the difference between safely making it through the night and being eaten by a giant saber-toothed tiger. We have to, as we were hunters and gatherers, we had to look for patterns to ensure that we weren't walking through the forest and we would look for patterns in the trees. We'd look for patterns here, patterns there, to make sure that we're not stepping on a snake or that we're not thinking something is a rock and having it turn around to be this giant animal that's going to eat us. I mean, an example for me is when we were living in Costa Rica, I saw snakes everywhere. I had never thought about snakes before in my life, living in the city. But then, one day I happened to see a snake, and after that, every time I saw that pattern, whether it was a stick on the ground or just the way the leaves were laying, I thought it was a snake. My eyes began picking up that pattern everywhere because I once saw a snake in the wild. So now I thought everything was snakes. It was just my survival mechanism kicking in. We mistake that randomness for a pattern. So just random fall of leaves, the random way the branch happened to be laying on the ground, so on and so forth, caused me to think that it was a snake. Again, just our survival mechanism. Good thing to have, and better than just traipsing through the jungle, willy-nilly stepping on things. But it's important to recognize that randomness in the world, our minds are wired to look for patterns, and that's the same in the marketplace. A lot of us, when we're in the marketplace, we're fearful because we don't want to have a loss of our account, loss of money, and we mistake randomness in the marketplace for a quantifiable pattern that we could either capitalize on or might keep us out of something. But it has nothing to do with it. The randomness in the marketplace is the randomness in the marketplace, and when we're looking at chart patterns for that, it doesn't offer us any advantage. We need to look at the things that are real and quantifiable as we are trying to make our trading decision. Another study that James did was just a random study that revealed that seems to reveal patterns, right? But it's just random. We could take dice rolls, for example. Everyone would understand a dice roll is random, but if you look at that data over a long enough period and analyze the dice rolls, you could probably start seeing patterns in that. You might see something like 2 6s followed by a 4 80% of the time, over and over and over if you did a course of 1,000 rolls. And then you may think that's a pattern. So if you see 2 6, if you see a 4, you'd say, oh, well, the next 2 are going to be 6s. It's random. You don't know what it's going to be. But if you had enough data, you could look at that and think it was something that was quantifying, that had a pattern to it. Same with coin flips. We could do a coin flip over a large enough sample size, and you'd probably find something like 3 heads or followed by 2 tails, and then a heads again will reoccur. I lived in Vegas for a long time. You see it with roulette. The casinos know what they're doing. They post those number boards above the roulette table because they know that people are going to walk by and stop, and they'll start seeing patterns. They'll see, oh, well, if there's been, if the numbers come up on black 4 times in a row, it must be ready for a red to hit, and they'll bet red. It's totally random. There's no way to predict what's going to come up next. The wheel spins, the ball goes, it's going to land where it lands. There's nothing that is not random about that. But because we're predispositioned to find patterns, the casino knows if they put that board up there showing the numbers that have come out, you're more likely to say, oh, I know where it's going to hit. I'm going to bet red, or I'm going to bet second 12, or I'm going to bet, green, or whatever it might be. Totally random. And I've stood there and watched people just lose because they're certain that their number is going to come up next based on the quote pattern that's been displayed on that board. It has nothing to do with it. These are things that appear to be patterns, but they're completely random. There's no advantage by betting on future numbers. There's none, but we think there is because we're wired that way. So it's important to realize that and think about that next time you're in the marketplace. Technical analysis, looking at chart patterns, is nothing more than random detail. We need to focus on the things that are actually quantifiable, known, repeatable facts about the marketplace that are going to offer us more opportunities for a positive outcome. So in summary, many traders assume that a repeating shape must be a pattern. It's not. There's no scientific examination that has proven that a technical strategy has any better than a 50% probability. Real technical analysis does not look at shapes. Real technical analysis identifies market conditions necessary for making profit. They're quantifiable conditions, and they're based on sound logic. So if you'd like to learn more about this, I hope this has been eye-opening for you. I'd love to have you click that link below, get registered over at Complete Currency Trader, and get into that free sessions, the free training with James, and he'll take you through some additional training on what we've covered here at a very high level, and even teach you a great trading method that can be used right away, starting right now, with the tools that he has available on the website completely for free. And I think it'll help you see a brand new way of trading that will really help you be consistent as you grow and learn more. So there you have it. Look to stay tuned, and we'll have some great additional content for you soon. Have a great day.